So welcome guys. Let's wait so that others can join as well and then we'll start. Meanwhile, I have also shared the sheet that we covered yesterday. Good evening, guys. A very warm good evening to all of you. Let's wait for a couple of more minutes so that others can join as well and then we will start. Good evening, VR. Good evening, GA. Yes, I am sharing the sheet again. Every one of you are asking me for the sheets. Although I have shared it, I am sharing it again. Good evening, guys. Good evening, everyone. So let's wait for a couple of more minutes so that we can be a good strength to start with. And then we will continue from where we left off yesterday. Also, one important thing that we missed to discuss and that we are going to discuss today, that since we have made our model very much dynamic, yes, PJ, please do ask your doubt. Since we have made our model dynamic, we will be adapting some tricks we will be implementing. Yes, soon we will be shifting to those timings that you're suggesting, PJ, very soon. So it's just the matter of few weeks. So I have already raised the concern to the team, to the management, and they are thinking about it. Although the challenge is, many of you are working professionals, and they want a time that is suitable after working on Saturdays. Also, many of you are associated to uh, some countries where the suitable time is this. So, in order to get a time which favors everyone, this time has been finalized, but it will change. It will change. For few days, we will have to bear this timing for few days. After this, they will have to compromise our foreign students. So this is how it will go. So soon we will be shifting to timings, probably 4 to 6 or something like that. So I have raised the concern over the to the team, and soon we will be connecting over it. And nevertheless, we will be starting with relative valuation part. But one thing that we wanted to discuss over here is, let's suppose this is the model that we have made. I want, this is the model that I have made is of Maruti Suzuki. The model that I have made is of Maruti Suzuki. Now, what if, okay, I got your point. I'll raise the concern to the team as well, PJ. So this is the model made on Maruti Suzuki. This is the financial model on Maruti Suzuki. Like we discussed, I'm going to make this heading dynamic. Maruti Suzuki sorry is equals to data sheet Maruti Suzuki India and financial model. This is the model that we have made. Good evening, everyone. A very warm good evening. We have not started with our session yet. We have made this model. Now I want to change this model that we have made on Maruti Suzuki to, let's say, some other company, probably Imami or any of the company of your choice. Let's say Coal India. So I am closing this model. I will go to screener.com. Let me know if you guys are able to see the screen uh, in a minute. Share screener dot in slash Excel. Screener dot in slash Excel. They are asking me to register, so I will register over here. I have registered through my Google account, Excel. Now they are asking me to upload customized Excel file. So I will choose the file, Maruti Suzuki July 2024, open it and upload it. Once the model, once this model is uploaded, I will search any of the company of my choice, let's say Coal India, or any company of your choice. If you want Tata Motors, you can go with Tata Motors as well. Export to Excel, brackets open. So the file has been downloaded and the new file that we can see over here, all the values that we can see over here is of Coal India. The valuation that we have got is of Coal India as well. Now, this valuation that we are getting, please try to understand, guys, based on this valuation that we have calculated over the period of time based on our model, this is not the true intrinsic value of the company. Why? Because true intrinsic value of the company is sensitive to many assumptions. This model that we have made is for educational purpose only, with a rationale to understand that how the prices of the securities are determined, what are the various approaches to value a company. This is what was the purpose of making this financial modeling and valuation course. Now, the problem is that we all are not SEBI registered advisors. We cannot value a company and based on our valuation give recommendation. But the idea to understand that how recommendations are given, how when a company says a buy recommendation, based on what are the rational, based on that, based on which they are working, and based on that, what recommendation that they give. This was the purpose to understand the model. Now, the DCF value that we are getting may be in the range, may not be in the range, but this is not the true picture or true intrinsic value of the firm. Now the question is, the another part to discuss is the true intrinsic value of the firm is not known. Even Ashwath Damodran sir, who is considered to be the father of the valuation, he says in his classes that true intrinsic value of any firm is undiscovered. Even he makes errors while calculating the intrinsic value of the firm. And what an analyst, what a finance student can go do is try to go as close as possible to the intrinsic value. Nevertheless, we also know that in case of equity, we value the firm and prices of equity securities are different from its value. In case of, while deriving the value of the equity securities, the valuation of that security can differ from analyst to analyst, from person to person. What I am trying to mean over here is, if 100 of us are preparing a model on equity valuation and 100 of us are getting different values, none of us are right and none of us are wrong. as far as we have followed the basic principle and concepts of finance, we can get different assumptions. We can take different assumptions based on our own research. And when you will be working on the firm, there would be different teams who will be collaborating together to make those assumptions. For example, the DCF value, here growth rate that we have taken is 7%. This is based on some given source that we found on internet. Probably the company that you might be working on as an equity research analyst or a financial analyst might have their own economic research team or global macro team who will be searching and who will be uh, working on researching on the different economies and their growth rate. They will derive some assumption for you. They will derive an output for you, and that output you might have to be implemented in the model. If you are interested in working on that field, so finance is a broad area. You can make career or on your own choice based on the subjects that you personally like. If you didn't enjoy the equity part, you might have enjoyed the fixed income valuation part. You can try to make up your career on fixed income valuation. So what this course gives you is a broad perspective about each and every, some idea, some taste about each and every aspects of finance. Coming to this part, this was important because this is how we can make our model adaptable. This is how we can make our model adaptable. The ratios that are over here is now of the new company, that is Coal India. So based on this, you can make your own model. You can also check the changes. Some of these changes you can check by matching the data, whether the data has been rightly associated to the model, rightly linked to the model. So as we can see here, negative cash conversion cycle. If I try to search for a different company, let's say Dabur, these data will automatically get adapted based on the values uploaded by screener. So all this was just the trick based on which you can work on your model. And you can make your model adaptable to new companies. So this is how we make the model dynamic so that we don't have to work hard again and again. Once you have downloaded the company with Dabur, let's say, yes, I will be repeating how we uploaded this. Now you don't have to construct the model again. Now what you need to do is, if you feel that Dabur was not affected by, Dabur India is an FMCG business. FMCG was not that much affected by COVID as compared to other businesses. Still, we can see in a year 2020, 23, 24 is still good, and 16, 17, 18. So this fluctuation in 2020 may not be due to the COVID-19 pandemic. So if you feel that Dabur is a non-cyclical business, it is into FMCG and it was not affected by COVID, you just need to change your assumptions. You don't need to make the whole model again. You just need to change the assumption where you can take average, and based on your analysis, you need to change the assumption. So this was just an example. If you feel that you don't want to change, you can keep it as it is as well. And based on what you have researched about the company, what you have interpreted about the company, based on that, you can interpret and incorporate that data into your model. You don't have to make the model again and again. That is the only purpose of making this model dynamic. So the values that are driven is not the accurate values. And based on this, you should never suggest your friends, uh, professional colleagues, family members, or anyone to buy or sell a security based on the DCF valuation that we are deriving. This model is for educational purpose only. And also, while posting this model through various social media platforms or sharing these models to your friends, do mention as the disclaimer that this model is just for the educational purpose. Okay. Now, how I did this, I had screener.in. I logged into screener.in, screener.in/Excel, screener.in/Excel. This is the URL that we used. I'm posting the URL in the chat box as well. choose file, upload the file that we have made and upload. Once the file is uploaded, you will redirect to the home screen. Now you can search for any of the company of your choice. May it be Tata Motors, Maruti Suzuki, or any company. Export it to Excel. And based on that, you will be having your new model. See, the values are getting negative over here because the assumptions that we took based on Maruti Suzuki might not be suitable for this Tata Motors company. Okay. I am sharing the sheet of Maruti Suzuki. Now, let's start with our discussion for the day on relative valuation. Now, tell me guys, let's make a session a bit interactive because this is the point where I can get inputs from you guys as well. Now, tell me that if there was already such a complicated approach like DCF, what was the need of relative valuation approach? What was the need for a valuation approach like DCF, relative valuation, if there was already DCF valuation in the picture? Did we discuss this? What was the need? And what is the rationale behind getting or discussing the value of a company, deriving the value of the company based on relative valuation? Every approach has their own pros and cons. That is true. What is the pros of DCF valuation approach and what are the cons? What are the pros of DCF valuation approach? What are the cons? At least tell me the pros. Since you have worked on this model from last 1 month, tell me, why did you work on it? Okay, GA is saying, GA is highlighting one of the cons. DCF valuation approach is very much technical and not everyone can follow it. Very true. It is a bit complicated approach. Next, it works on the principle of free cash flows and not accounting profits. DCF works on the principle of free cash flows and not accounting profits. We saw in our past class that why free cash flows are is a better matrix to evaluate or value a company rather than accounting profits, because accounting profits are more subject to manipulation. Okay, it covers detailed analysis of the company. True. The second con is it is very much sensitive to discount rate assumptions. What I mean by that? Now, you have your model ready. We have taken assumptions for growth rates. We have taken assumptions for WACC. We have calculated cost of equity. We have taken assumptions for RM from through our research. We have taken assumptions for RF, that is risk-free rate. Try tweaking in. What do we mean by tweaking in? So when you will work on the floor in industry, you will use the word tweaking. Tweaking means changing the assumptions of the model. So when earlier the assumption was 7%, instead of 7%, I am punching it 8%. I am seeing that the valuation is getting changed. Valuation is getting changed. So you will also see that the assumptions that we use in DCF valuation, the valuation approach and the valuation that we get based on these assumptions is very much sensitive to the assumptions that we use. So the value that derive for the firm is very much sensitive to the assumptions that we use. Okay, GV is saying something, but I only attended the first one because of some personal issue. I was out of it totally. You that should I first complete all previous class or where's today's class right now? So don't worry, GV. We are starting with the new topic today, that is relative valuation. So to overcome one of the major technicality of DCF valuation, the pros of relative valuation, it is a much simpler approach. It is a much simple approach. It is easy to understand, and the relative valuation model are comparatively made quickly as compared to the DCF valuation model. Now, let's understand few things. Anyone remember what are the ratios that we covered for relative valuation in the last class? First was price to earnings. Second was price to book value. Price to earnings is also called PE. Price to book value is PB. Third one, price to revenue. Okay, the order might not be the same. Price to revenue. Fourth one, EV to EBITDA. Fifth, EV to revenue. Sixth, EV to EBIT. Seventh, price earnings to growth. Eighth, dividend yield. Dividend yield. These were the 8 ratios. Did I miss anything? These were the only 8 ratios that we discussed yesterday. Perfect. Let's try to understand each of these one by one. Now, relative valuation approach is also known as multiple based approach. Multiple based approach. Why multiple based approach? Because these are based on ratios. And interpretation of any ratio is nothing but numerator as a multiple of denominator. Please focus guys over here, because if you understand this, the basic things, I am touching upon class 2 again. And if you understand this basic thing, the rest of the portion will be very easy for you. It would be a cakewalk for you. Numerator as a multiple of denominator. Let's suppose 8 is my numerator. I divide it by 2. So 8 is my numerator. 2 is my denominator. What is the answer that I will get? It is 4 times. What I mean by this, 2 is 4 times of 8. Sorry, 8 is numerator as a multiple of denominator. 8 is 4 times of 2. Remember this formula. 8 divided by 2, hi Apurv, is 4 times. No worries, Apurv. So we have not discovered much yet, but I would suggest you to go through the recordings. I just shared some tricks, and we are starting with the relative valuation approach, where we discuss that relative valuation approach is also called as multiple based approach. Okay, so 8 is 4 times of 2. 8 is 4 times of 2. Based on the same logic, every ratio means that numerator is the particular times of denominator. Yes, I am repeating again. So we have discussed relative valuation approach is also called a multiple based approach. Why? Because we are touching upon the second standard concept again. Any ratio is nothing but a numerator divided by denominator, and the answer to numerator divided by denominator gives us the interpretation as numerator. Answer to numerator is what times of denominator. The answer to numerator by denominator gives the answer to numerator is what times of denominator. This is the second standard maths that I wanted to revise so that we can move forward with our first ratio, that is price to earnings ratio. Let's say we will come to the formula later. Let's say there is a company A which has price to earnings ratio as 10. There is a company B which has a price to earning ratio of 15. What is the interpretation of price to earning ratio of 10 for company A? And what is the interpretation of price to earning ratio of 15 for company B? Do you want to try yourself for the first part? Please try yourself for the first part. Please let me know what would be the interpretation. How will we read these ratios? If we are not able to interpret it, these are mere numbers. 10 and 15 are just numbers. If we are not able to comprehend and understand this, what does that mean? The price to earning ratio for A is 10, B is 15. What would be the interpretation? If we pay 1 rupees, we will earn 10. No. For earnings rupees 1, we need to invest rupees 10. Okay. Okay. The interpretation, the professional and official interpretation that might you will see in many of the books is company A is priced 10 times its earnings. 10 times its earnings. Please correct me if I am wrong. Please correct me if you are not able to make sense to this statement. Company A is priced 10 times its earnings. Company A is priced 10 times its earnings, whereas company B is priced 15 times its earnings. 15 times its earnings. Another interpretation, another perspective for this, that when you are investing 10 rupees in company A is generating 1 rupees, whereas when you are investing 15 rupees in company A, company is generating 1 rupees. When you are investing, when you are paying 10 rupees in company A to be the owner of 1 rupees. 1 rupees. If you want to get the net income of 1 rupees from company A, you will need to pay the price of 10 rupees. If you need to get the net income of 1 rupees from company B, you will need to pay the price of 15 rupees. The logical interpretation is company A is priced 10 times its earnings. Company B is priced 15 times its earnings. Which company is priced more? Which company is priced more? Which company seems to be comparatively overvalued? Company B seems to be comparatively overvalued as compared to company A. Why? Because company A is asking you for 15 rupees to generate 1 rupees net income. Company B is asking you for 10 rupees to generate 1 rupees net income. Who is giving you a better deal? Who is giving you a better deal? Company A is giving you a better deal, right? Now, there is a concept of trailing PE, trailing price to earnings, and leading price to earnings ratio. Yes, we will come to sector average as well. There is a concept of trailing price to earnings and leading price to earnings. Basically, when it comes to price to earnings ratio or any ratio where price or earnings, sorry, price or enterprise value, where price or enterprise value is in numerator, when I am writing this short note, if possible, please note this down. Naveen, this is for you. Basically, what we have discussed over there is if price or enterprise value is in numerator, the lower multiple gives a better deal. When, always remember, when price or enterprise value, this is not divide but or, price or enterprise value is in numerator, the lower multiple gives a better deal. Now I am coming to the trailing and leading part. Naveen, if you are comfortable with this note, please let me know if you are comfortable with this note so that I can move forward with the trailing and leading PE part. Perfect. Trailing means trailing versus leading. Which word is giving you an idea about past? Which among these were trading versus leading? Which word is giving you the idea about past? The sentiments reflected about past is through the word trailing. So this is related to past 12 months. This is past 12 months. Leading PE, next 12 months. Next 12 months. So what would be the formula for trailing price to earning? Price of year 0, price of this year, price of this year divided by earnings of this year. This year price divided by this year earnings, past 12 months earnings. Leading PE, on the other hand, is price of this year divided by earnings of next year. Question is how we will get earnings for next year. Earnings for next year we will get through forecasting or using earnings growth rate or using earnings growth rate. I'll come to how we will be getting the earnings growth rate. but this would be a bit heavy for all of you. Some of you will be able to understand. If PE ratio is negative, will that be good by when to compare to another? I'll come to that. Very genuine question, Ronak. A negative PE does not make any sense. Why? Does not make any sense. Why? Because, simply because price can never be negative. Price can never be negative. Price can never ever be negative. If PE is negative, it means that earnings are negative. If PE is negative, it means that earnings are negative. And if the company is in mature stage of business, if the company is working for past 10 to 12 years and still giving you negative PE, stay away from that company. That is a big red flag. That is a big red flag. Stay away from that company. If a startup can have a negative PE, that is perfectly fine. For initial years, the company is burning cash and that's why they are having negative PE. That is fine. But if the negative PE is persistent for next 10 to 12 years, a company is in mature stage is having a negative PE, stay away from that company. Okay. Now, how are we going to get the next year earnings? How are we going to earnings for next year? So earnings for next year would be this year earnings into 1 plus growth rate. 1 plus growth rate. Now, how will we get this growth rate? This growth rate can also be called as sustainable growth rate. The formula for which is ROE, return on equity, into retention ratio. Formula for retention ratio is 1 minus dividend payout ratio. So ROE into 1 minus dividend payout ratio may give us sustainable growth rate. Nevertheless, to keep things simple, for now, we will be discussing things on trailing PE, trailing price to earnings ratio. Now, never ever, please try to understand this, never ever make decision based on one single multiple. Based on what? If it is not a dividend paying company, then the retention ratio, if if it is not a dividend paying company, then dividend payout ratio will be 0 and the retention ratio will be 1. And if the retention ratio is 1, it means that company is retaining all of its earnings. 1 is nothing but 100%. So ROE will be its growth rate. What will you please explain trailing PE, sir? Yes, I will explain trailing PE. The only difference, the only simplest difference between trailing PE and leading PE is, please try to understand, the price is same. The numerator is same. The price for both trailing price to earning ratio and leading price to earning is same. The only change is happening in the denominator. And what is that change? In trailing PE, we consider last 12 months earnings. And in leading PE, we consider next 12 months earnings. Now the suggestion was, never make decisions based on single multiple. Now we will see a ratio in the later part that we are going to discuss today, that is price earnings to growth rate. Price earnings to growth rate. There we will see that even though if the PE ratio is high, even the PE ratio is high of a given company, as compared to industry, as compared to the industry PE, still we should invest in that company based on price earnings to growth rate ratio, because the reason being that particular company, that particular company may deserve the higher PE. That particular company may deserve the higher price multiple. Why? Because the future growth prospects of the company looks good. We invest in a company to get out the future benefit from it, and based on that we will be calculating and interpreting PE ratios. So the first part was PE. Everyone comfortable with the PE part, so that I can move on to the next ratio? When I say multiple, it means ratio. Yes, the PE ratio is nothing but multiple. Now, there is an exercise for you. Let's say the median price to earning ratio of a industry, of a pharma industry. By the way, which company did we selected yesterday? The median price to earning ratio of a pharma industry is, let's say, 22 times. The earnings for the company, is 300 million. 300 million. Now, what would be the price for the company? What would be the intrinsic value of the company? What should be the should be price of the company? What would be the should be price of the company or intrinsic value of the company based on this, based on these two data? What would be the should be price of the company? Very true, GA. You are correct. Some of you are wondering how can we calculate the price of the earning or intrinsic value of the company based on these two numbers only. Guys, it's price to earning. Price to earning is given as 22 to you. Price to earning is given as 22. Earnings are given as 200. Sorry, 300. Earnings over here is given as every price multiple works on the same logic. TD, probably there might be an issue from your end. Guys, is my voice clearly audible? Do you want to try again? Do you want to try again? Okay, okay. This time, I want a recommendation from you guys based on PE multiple. Two things. First, yes, the value would be 22 into 300. Correct, PJ. Now, even to PJ, I'm saying PE. So, slip of tongue. Bear with me. Now, recommendation, what I need from your end is whether the stock is overvalued or undervalued. This is the first question. Second, whether the recommendation is buy or sell the security. That is question 2. I am giving you the data. Median PE of the industry, median PE of the industry is 15 times price of the company is 500, or let's say 1500, earnings of the company is 200, all these values in millions. Give me, you have to give me, this price is what price? This price is market price. And I need you to calculate intrinsic value of the company. I need you to calculate intrinsic value of the company, or should be price of the company. First of all, give me the intrinsic value. Okay, waiting for more responses. I've started receiving response, but I'm not disclosing the answer yet. Now, intrinsic value is 3,000 million. The price is 1,500 million. The right price for the company should be 3,000 million and the price is 1,500 million. The security is undervalued, and when the security is undervalued, we give a buy recommendation to it. We recommend to buy that particular security. Now, based on this logic, price to earnings is equal to market capitalization divided by net income. Don't get confused. This is just the fancy word. Market capitalization is the price of the whole company. Net income is the earnings for the whole company. If you want to evaluate in the per share basis, it's MPS, market price per share, divided by EPS. Tell me if this makes sense. Tell me if this makes sense so that we can quickly jump up to the next set of ratios. PJ, you are not understanding this. Anyone has any doubt in this part, please let me know. Okay, PJ, what part are you not understanding? Please let me know. So the price, what is the formula for market price? What is the formula for market capitalization of the company? The formula for market capitalization of the company can also be written as market price per share multiplied by number of shares. Net income of the company can also be written as earnings per share multiplied by number of shares. Number of shares gets cancelled, and the amount we are left with, the ratio we are left with, is nothing but MPS upon EPS. The formula, the ratio is price to earnings ratio. If you are evaluating price for the whole company, that is market cap, you should take earnings for the whole company, that is net income. If you are evaluating price on a per share basis, that is market price per share, you should evaluate earnings on the per share basis as well, that is earnings per share. What part do you want me to explain again, PJ? Please let me know, please. Please put digits, numbers. Okay, you are saying numbers. So let's say if market cap is 200 million and net income is 50 million, and the company is having 100 million shares outstanding, or let's say 10 million shares outstanding. Let's try to understand this with numbers. Okay. Market cap is equals to 500 million. Yes, you will yourself be calculating intrinsic value this time. market cap is 500 million. Net income is 50 million. Number of shares outstanding 10 million. Median PE of the industry is 25 times. Give me the intrinsic value of the company and also the recommendation. In recommendation, I need both the things, whether the security is undervalued or overvalued, and whether you will give a buy or sell recommendation. Everyone, please do practice. Prajwal, please do practice this. Please let me know the answer. Try practicing this through any of the formula, any of these two formula. Two different answers. One is saying intrinsic value is 50 million. One is saying 1250 million is intrinsic value. RK is giving us a buy recommendation. First, guys, please try to calculate the intrinsic value. Okay, NB is confirming with GA, that is 12,500. Sorry, GA said 50. NV is confirming with GV, that is 1250. 12,500. Okay, so three responses, three different answers. We don't know the right answer yet. Even I have not calculated it yet. Let's see what will be the answer. No worries, GA. The formula, median PE is 25 times. Also give me the price to earnings ratio of this particular company, A Limited. Give me the price to earnings ratio of this particular company. The price to earning ratio is 10 times 500 divided by 50. Give me the MPS of this company, market price per share. MPS would be market cap divided by number of share. MPS would be 50. MPS would be market price per share would be 50. Why? Because MPS is market cap divided by number of share. Give me EPS, earnings per share, net income divided by number of share. Net income would be 5. 50 divided by 5 gives me 10. So my PE multiple is 10. The median PE industry is 25. My stock is undervalued. And I will give my stock is undervalued. And if the stock is undervalued, we will buy the security. Next thing is, if EPS is 5 and price to earning ratio is 25, so price to earning is 25, EPS is 5. So let's substitute earnings with 5. When this earnings goes over here, 25 into 5 gives me the price as 125. So the intrinsic value of the company is 125 rupees. Now, what is the current price of the company? Current price. What is current market price of the company? There is 50 and the intrinsic value is 125. So the security is undervalued and we will be investing in this security. If the company is on 200, how it goes up by manipulation, quarterly result performance, or fundamentally. So AV, there are various approaches through which a company can manipulate its earnings. Although I'm not sure what you're telling through this statement, that I have one question. If company is on 200, what does we mean by that 200 number? Median PE. Okay, I'll come to the median. I'll explain the part about the median PE. AV, current market price, it's on 200. Is on too high, it goes up by manipulation or quarterly result performance or fundamentally. So let's suppose there are various approaches to depreciation, right? There is straight line depreciation, There is depreciation through double declining method. And there are 6 to 7 different approaches to depreciation that usually chartered accountants use to report their performance of the company. Now, one depreciation method can increase the depreciation expense. I'll come to your doubt, MY. Mridula, I'll address your doubt. Just give me a second. Let me address this doubt first, that how can a company manipulate their results and how the stock price will be affected by it. So if depreciation is increased, the net profit will, what if depreciation expense is higher as compared to earlier years, what will be the impact on net profit, whether it would be higher or lower? If depreciation is an expense and expense is higher, the net profit would be lower. And if depreciation is lower, the net profit would be higher. And if a firm reports higher net profit as compared to previous years, a sudden rise in net profit as compared to what it has reported in the historical years, the market will react to it and see it as an opportunity to invest in that company. More people will invest in that company. The share price of that company will increase due to increase in demand for the shares. Higher the demand, higher the share price. And why? What was the reason driven behind the share price? The higher net profit. And the reason why company reported higher net profit is because it just changed the depreciation method. Now, whether there has been a manipulation in the statement or not, it is given by something called as auditor's opinion. There is an auditor appointed who are generally CAs. They have to check whether the company has made any manipulation in their financial statements or not. So in auditor opinion, the auditor of the firm, this also becomes the very important matrix while trying to search for a company, trying to source a potential target company for your investment purpose. This segment in annual report that covers auditor opinion. If auditor is saying that the auditor is saying that there is no manipulation, then the share price won't be affected by it. But if the auditor is saying that there is signs of manipulation or companies indulged in fraud, then the market will react very adversely to this news. Also, one thing that you need to look into the companies to source the possibility of manipulation is whether the company is keeping on changing the auditor or not. If company is changing its auditor every year and the auditor of that particular firm is not a well-known entity, a comparatively small entity, that could be also a sign of earnings manipulation. So this is something that you will have to read on the annual report, although this was not related to relative valuation, but still. Okay. Difference between PE and median PE. Okay. Now, to let you guys know what is median PE, I'll again have to go to something basic, some few basic things. Measures of central tendency that you might have covered in 8th class. When did you first heard the word central tendency? And when you first heard the word mean, median, or mode? These three things: mean, median, and mode. And why I am continuously stretching on the word median and ignoring mean and mode? Guys, remember these terms: mean, median, and mode. Mean is simply average. Median is the middle value. And mode is the number with most repetition, most repeated number. The observation with higher frequency. I don't want to use these technical terms. Otherwise, You will get confused. The observation with highest frequency is called mode. Just basically assume it to be the most repeated value. I'll give you a data. Company A, B, C, D, E, F, G, H, I. P of these company 10, 9, 8, 7, 6, 5, 4, 3, and 2. You have to calculate mean, median, and mode for these companies. Mean, median, and mode for these companies. And let's say there is another company J, which again has a PE of 2. So mean for such a company would be mode is 2, very easy. The number which is highest repeated. Mode is 2. Median is mean is 5.6. Okay. Median 5.5. Now let's just do one thing. Let's just change this 2 with 12. Change this 2 with 12. Change this 2 with 12 and give me the new values for mean, median, and mode. To solve your doubt, there would be no mode for this company, or all these numbers would be the mode. So let's ignore the mode part for now. Now the contest is just between median and mean. Mean is 6.6. Median is 8.5. I don't think so. Median is 6. MY is saying median is 6. Waiting for a few confirmations. How will you calculate median? To calculate median, you will arrange this in the chronological order: 2, 3, 4, 5, 6, 7, 8, 9, 10, and 12. So how many observations are there? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Which are the middle observations? Fifth one and sixth one. So 1, 2, 3, 4, 5. 6.5. 6.5 is your median. Now change this median to 24. Sorry, change this observation to 24. This time calculate the mean. Change these observation to 24 and calculate the mean this time. Change this observation to 24 and calculate the mean this time. I have erased 12 and changed it to 24. The mean this time is 7.8. The mean this time is 7.8. Calculate the median. Will median change? Will median change? Median will be same. Change this 24 to 946. Mean will change. I don't want to know the new mean, but mean will change. Mean will be very much fluctuating. But will median change? No. Because there is a statement in statistics which says mean is subject to outliers. Mean is subject to outliers. What do we mean by that? Let's suppose 1, 2, 3, 4, 5. If this is the observation, this is the data, the mean would be 3, the median would be 3. Please do calculate if I am wrong. But when I change this 5 to 15, the mean will change, but the median will remain same. If I change this 15 to 155, the mean will change, the median will remain same. If I change this 15 to 15555, this mean will change and median will remain same. Why? Because mean is subject to outliers. Now the question is, what are outliers? What are outliers? So let's suppose these are numbers. These are numbers 1, 2, 3, 4, and 363. What seems to be an outlier? The odd one out is the outlier. The odd one out is the outlier. Remember, we used to circle the odd one out in the first class. Now, when I use mean to calculate my intrinsic value, my mean will keep on changing if I am changing the outlier observation or the last observations. The extreme observations, if I am changing, my mean will change. So if I take a company with PE of 363, the intrinsic value, just giving you an example, can be 200. On the other hand, if I am taking a company with the PE multiple of 500, the intrinsic value can change to 2000. So the intrinsic value keeps on fluctuating. Why? Because of mean, while using mean. So based on this logic, we will be avoiding mean, and to get a better idea of intrinsic value, to get a better range of intrinsic value, we will be focusing our discussion on median. And that is why we are using median every time. Now, what is industry median or median PE? What is median PE? And guys, I am explaining this for median PE. The same logic applies for PB, price to sales, EV to EBIT, EV to EBITDA, and every other multiple. This measure of central tendency, don't make me repeat this for each and every other line item. This would be the same. This would be the same logic would be followed for each and every ratios. I hope this makes sense. Okay, now what is median PE? When we arrange the PE, the price to earning ratio in a chronological order, let's say 8, 9, 10, 11, 10, 12, 14. Based on that, if we calculate the median value of the PE, that is 10, this will become my median PE of the industry. Industry PE or median PE. Based on this, we will get our median PE. Okay. Now, since we have done a very much detailed discussion on this, now let me just go through each of the ratios in a very quick manner. And based on what we have discussed as of now, I think you will be able to comprehend and give me the interpretation of what does the particular ratio tries to tell you. So what does price to earning tells you? What does price to earnings tells you? Price is how much times of earnings. Price is how much times of earnings. Lower the better or higher the better? The company with a lower price to earnings is better or higher price to earnings is better? Lower the better. Very good. Similarly, what would price to book value tell you? At what multiple the company is priced with respect to its book value? Remember this. Company A is priced 10 times its earnings. At what multiple? You need to ask the question to yourself. At what multiple the company is priced with respect to its book value? At what multiple a company is priced with respect to its revenue? At what multiple the enterprise value of the company is with respect to its EBITDA? At what multiple the enterprise value of the company is with respect to its revenue? At what multiple the enterprise value of the company is with respect to its EBIT? Now, this is a very unique ratio and we are going to spend our some time on these ratios. But tell me, are you guys clear based on the simple logic? Numerator as a times of denominator is what these ratios answer you. Numerator as times of denominator is what these ratios answer you. Numerator as times of denominator is what these ratios answer you. So based on this logic, will you be able to interpret each and every ratio except PE, price earnings to growth rate and dividend yield? We are going to discuss that. But at least these six ratio, are you guys comfortable with? Please try to ask this yourself. Please try to ask this yourself that what could be the interpretation of the given ratio. If you want a 5 minutes break, we can take a 5 minutes break and make sure that you understand each of these six ratios. Make sure you understand all these six ratios. We will go to price earnings to growth rate. So what is book value? Book value is market value of assets minus market value of outstanding liabilities. What are outstanding liabilities? Liabilities other than equity. So book value of equity, let's suppose EV, full name of EV is enterprise value. Good guys, ask your doubts. Book value. So someone asked yesterday about the face value, right? 10 rupees was the face value of the company. Now, if 10 rupees is the face value of the company and 1000 company has 1000 shares, that given company will have 10,000 as its book value. That company will have 10,000 as its book value. The remaining adjustments will be made in reserves part. That is in detail we are going to discuss in the part where we will be discussing M&A, merger and acquisition. But book value is the formula for book value of the company is market value of assets minus, sorry, book value of assets minus book value of liabilities, not market value, but book value. Book value of assets minus book value of liabilities. All the liabilities other than equity. That is book value. Comfortable, Ronak, with this? Price to revenue, EV to EBITDA, EV to revenue, EV to EBIT. If you guys are comfortable, you can go on a break, but be right back on time. Be right back in next 5 minutes. We have to start with the modeling part of this after discussing price earnings to growth rate ratio. Meanwhile, let me take a sip of water as well and I'll be right back. And if you guys have some doubt, you can post that doubt in the chat box. Meanwhile, we are on a break for 5 minutes. Okay. So TD is asking, will relative valuation for new age companies like Zomato, Paytm, or Car etc. will work? Yeah, it would work if there is a comparable universe for these companies. If there are very few companies like in Zomato, the only two players in India are Zomato and Swiggy. In case of Paytm, there are very close aggregators like uh, Google Pay, Phone Pay, etc. Although Paytm serves a diversified set of their unique services. So if there since there is no close competitors to these company, we don't have close multiples, a reliable multiples, so we can't work on a relative valuation approach for these companies. But how relative valuation approach works for these companies is based on precedent transaction analysis. Precedent transaction analysis. What is precedent transaction analysis? Precedent transaction analysis is basically that if a acquisition or a series of funding rounds has happened prior to this, prior in the same given sector, uh, prior to when you are raising funds at 10 times multiples of revenue, that would be considered as a benchmark for raising funds in future. So let's suppose there is a company called OLX Cars. Although this is something related to startup valuation, but still, okay. There is a company called OLX Cars. OLX Cars has raised funds at $100 million valuation with the revenue of $10 million. So the revenue multiple for this company is 10 times. Now, when Car Dekho will go for raising funds, they will demand to their investors the 10 times multiple, and this 10 times multiple is coming from where? Based on the funds that have been raised by their competitors in the same industry. So this is called precedent transaction analysis. This is very similar. When I try to explain this, I always take the real estate example. The price of the property that you want to sell is determined by the price of the recent transactions that has been happened in your locality, and the price of the way through which you will value your own house is what your neighbors have sold their house for in the recent times. Now, if you guys are clear with this part, please let me know. Please let me know so that I can discuss the last two things, price earnings to growth rate and dividend yield. Guys, if every one of you are back from the break, are every one of you back from break? Perfect. Price earnings to growth. Simply, if PE, let's suppose PE is 20 times, growth is 9% or 10%, let's say 10%. We will come to that as well, Maniyar. We will come to that as well, that how can we determine that which ratio shall be used. So for Dabur, we will be calculating values based on each of these ratios. When we will be valuing Dabur, we will be calculating values based on each of these ratios. Okay. So price earnings to growth is simply 20 by 10, that is 2. This is how the calculation is this simple. Price earnings divided by growth rate gives us the price PEG multiple, PEG multiple, price earnings to growth multiple. Now, the question is, okay, I have to download this and then I will delete this. Okay. Now, yes, sustainable growth rate, correct. Let me just clear the drawing so that I can scribble a bit more. And also I will put that sheet in the chat box as well. Hi, hi Fresh. Now next thing. Yeah. Now there is a company A, company B, company C, company D. The price to earnings ratio of this company is 10, 12, 15, and 20. Price to earnings ratio of this company is 10, 12, 15, and 20. Intuitively, what do you feel? Which company shall you invest in? Which company would you invest in? Which among these companies, let's say these all these companies are in same industry, which company will you invest in? Intuitively, what do you feel? Intuitively, you guys are saying that you should go with company A. Okay, let me tell you this with a different example. There is a shopkeeper A, shopkeeper B, shopkeeper C, and shopkeeper D. Shopkeeper A is selling potatoes or tomatoes worth rupees 10 rupees, 12 rupees, 15 rupees, and 20 rupees. The vegetable seller is selling tomatoes for 10 rupees, 12 rupees, 15 rupees, or 20 rupees. From where will you buy those tomatoes from? From which seller will you buy? Are you going to buy tomatoes from? Which seller would you prefer? 10 rupees. Every one of you are saying 10 rupees based on the same logic that we applied over here. But guys, don't you think if company D or vegetable seller D is asking for 20 rupees, don't you think if vegetable seller D is asking for 20 rupees, the quality of those tomatoes would deserve that 20 rupees? The quality of tomatoes, yes, quality does matter, doesn't it? Quality of tomatoes might deserve that 20 rupees. Don't you think so? Now, if company A is charging 10 rupees, 12 rupees, 15 rupees, 20 rupees, you concluded that you should go to buy company A itself. But what if the company D out of all these company deserves deserves to trade at 20 times multiple, deserves to trade at higher multiple, deserves to trade at higher multiple? What if that is the case? If company D deserves to trade at a higher multiple, what if that is the case? Correct. Absolutely correct, GA. For that, we will be using price earnings to growth rate. Now, company A, company B, C, and D, 10, 12, 15, 20. These are the PE ratios. Now, let's try to calculate the growth rate. The growth rate of this company is 1%, 2, 5, 10. Sure, Fresh. Sure, definitely. Please raise a ticket about it so that we can connect one to one about it and we can discuss what the actual matter is. Fair enough. Calculate the PEG ratio, price earnings to growth ratio. Calculate the price earnings to growth ratio over here. 10 times, 6 times, 3 times, and 2 times. 10 times, 6 times, 2 times, and 3 times. 3 times and 2 times. Now, based on price earnings to growth ratio, which company seems to be undervalued? Which company seems to be undervalued? Company D. This says that this says that although the company D is currently priced at the earnings price to earnings ratio of 20 times, in the coming future, this is price to earning ratio. In the coming future, the growth of earnings would be much higher as compared to its peers. The growth of earnings would be much higher as compared to its peers, and this will reduce the overall price to earning ratio, making this company undervalued in the long run. Guys, are you understanding the logic? This is very interesting over here. In the long run, when earnings are going to increase for these company at a higher growth rate, since denominator is increasing, the overall value of the price earning ratio, PE ratio, will fall eventually in the long run, and probably this could end up below 10 in the long run, maybe 5 times. So maybe today you might feel that these earnings are of this company D is overvalued based on the earnings what it is generating today. But consider this, you are not buying a share to buy today and sell tomorrow. If you have an investment horizon for 3 to 5 years, in the next 5 years, the earnings of this company is going to increase at a higher growth rate as compared to its peers. The earnings of these company company D is going to increase at a higher growth rate as compared to its peers. Because of this particular company deserves the higher multiple of PE ratio. Because of this, the company deserves the higher multiple of PE ratio, and there is nothing wrong about investing in a company, even though the company is asking for a higher price multiple. Why? Because future prospect of the company is looking better. Although the currently it seems to be overvalued, in long run, the earnings will overpower the price and the PE ratio will fall in the long run, making it undervalued. Guys, was this logical? Was this logical? Perfect. Now the question is, let's say price earnings to growth rate is median price earnings to growth rate is 10 times in the industry. Median price earnings to growth rate is 10 times in the industry. And growth rate for this company is 6%. Is 6%. Since this is we are evaluating in absolute terms, is 6. Growth rate is 6. The value for growth rate is 6. Ignore the percentage part for once. The growth rate is 6. What should be the PE of this company? What should be the implied PE based on this? G substituted by 6. The implied PE should be 60 for this company. Now, if you have earnings as 50 rupees, don't you think you can get the intrinsic value of the company through this approach as well? Although this is a bit complicated, but still you can get it. Earnings, you will substitute 50. Intrinsic value will be 300 this time. Are you understanding the logic? How can we get to intrinsic value of a company using PEG approach? Price earnings to growth rate approach. Everyone? Everyone, shall we try with a second example as well? Price earnings to growth rate. The median price earnings to growth rate in the industry is 12 times. Growth for the company is 3%. The implied PE would be, would it be 3000 over here? Okay, yes, 60 into 50. It would be 3000. Yes. I'm sorry, my bad. The implied PE over here would be 36. Earnings 50. What would be the intrinsic value or should be price? What would be the intrinsic value or should be price? 1800. Correct, everyone? Now, the most important part. Okay, we are left with dividend yield. Again, similarly for dividend yield, based on the same logic, formula for dividend yield is DPS, dividend per share, upon MPS. Let's say the median dividend yield in the industry is 10%. And dividend given by this company is 20 rupees. What should be the price for the company? What should be the price for this company based on dividend yield? Or make sure also, someone was asking how do we determine which ratio to use? Dividend yield is only used for dividend paying companies. And if your style of investment is to get regular dividend, then only you will use dividend yield method. It cannot be used for every company, but just for educational purpose, we will calculate it for Dabur as well. So it would be, the price would be 200. How? Dividend yield is equals to DPS upon MPS. Dividend yield is 10%. DPS 20. MPS, using simple algebra, MPS would be 20 divided by 10%, giving us 200. Now we are done discussing with all the ratios. One important thing that we need to consider, have I deleted that slide? Yes, my bad. Okay, we will consider one more example for dividend. This time PJ is going to help us out for solving it. Let's say, what is the formula for dividend yield, PJ? DPS upon MPS, dividend per share upon market price per share. If dividend yield, median dividend yield in the industry is 14%, and the last dividend given by the company is 63 rupees, based on this, can you give me the market price, the should be market price for this share, that is intrinsic value for this share, based on the simple calculation, simple algebra? MPS will go here, 14% will come over here. It's 63 divided by 14%. Whatever may be the answer, please give me the answer, guys. 450. TJ, are you comfortable with this time? Perfect. Now, out of all the 8 set of ratios that we considered, we need to get a requirement list. Now, what is requirement list? We need to make a requirement list for all the 8 set of ratios, and you are going to help me out. For example, the first ratio was price to earnings ratio. For price to earnings ratio, I need market cap. I need data for companies' market cap and earnings. That is net income. So market cap became my first requirement. Net income became my second requirement for the data. So I am going to make a requirement list, and you are going to help me out for each and every ratios. I hope you have noted it down. So first requirement was, first we need market cap. Second, we need net income. Third, what is the second ratio? Price to, let's say, revenue. So again, market cap upon revenue. I already have market cap with me in my requirement list. I don't want to add it again. So I will add revenue. Next, third ratio, price to book value. I already have my market cap by book value. I have my market cap with me. I will need my book value. Fair enough. Third, fourth. And for market cap, can I write market cap as the requirement of two things? Current market price and number of shares. Current market price and number of shares will give me my market cap. Okay, next, what is the fourth ratio? Please help me out, guys. Everyone, please do help me out. If I can remember, EV to EBIT, EV to EBITDA. So, fifth, EV to EBIT and EV to EBITDA. So, I will need EV, and for EV, I will need market value of equity, that is my market cap, market value of debt. If market value of debt is not given, we will have to consider book value as market value. So I'm just writing debt over here to get debt. And what else we will need? Cash and short-term investments. Cash and short-term investments. Why? Because the formula for enterprise value was equity plus debt minus cash, if you remember from yesterday's class. So I have equity with me, that is market cap, current market price into number of shares. I need debt and cash, cash and short-term investments. So I am writing that in my requirement list. Cash and short-term investment. Sixth one, I need debt. With this, I will have my EV. Then I will need EBIT. And I will also need my depreciation and amortization amount. So I will have my EBITDA. So EV is figured out, EV to EBITDA is figured out, even EV to revenue is figured out because I already have revenue with me. Why? Because I already have revenue with me. So sixth, EV to revenue is figured out. Now, based on this, I will already have my PE. So to calculate price earnings to growth rate, I will need the growth rate. So to get the growth rate, ninth thing is sustainable growth rate. This is what I will need. I will already have my PE with me calculated over here. Next, last thing, dividend per share, DPS. That is the 10th thing that I will need. Dividend paid. And for dividend yield, I will need dividend upon market cap or DPS upon MPS. Based on that, I will get my dividend yield. I already have my market cap with me and I will need my dividend. So current market price, number of share, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Now take a pic of these guys and I am moving to screener and you will have to help me out reading all these data that I want. I will tell you why I have noted this down, why I have noted down this requirement list. I will tell you in few minutes, but make sure you have taken a pic of this and allow me to move to screener. If you guys will say you are ready, only then I am going to move forward. GA is ready, waiting for more reply. Okay, MY is ready as well. Shall I stop sharing this and move to screener? Perfect. Let's go to screener. Next, screener.in/Excel. I will search for Dabur India Limited. Now, for Dabur India Limited, I have some data for peer companies. I have some data for peer companies. Now, I will edit the column and I will customize what data set do I need. I am removing all the data points and you will tell me what data do I need based on the requirement list. Tell me one by one what data do I need. What is the first data that I need? If I can remember, it's market price. Do I have the option of current market price? Current price, yes. First one I have figured out market price. Next, number of shares, number of equity shares. Next, please tell me guys, what is the next thing that I need? Net income. Thank you. Net income. If net income is not available, you should search for profit after tax. Yes, I have figured out profit after tax. Next, book value. Thank you guys, it's book value. Done. Next, I need revenue. If revenue, you need to search for different names. It can appear as turnover. It can also appear as sales. Next, debt. Done. Next, cash. Cash, cash, cash. Cash equivalents. I will also have to see that whether cash equivalents are included in cash and short-term investments. Okay. Cash, 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 cash. Cash end of last year. Okay. We make sure we need to see that. We also need to have a look whether cash equivalents, short-term investments can be captured in cash equivalents. But let me see, just give me a moment. We will have to check whether cash end of last year is included in cash equivalents or not, or whether they have kept cash or cash equivalents separate to each other. Finally, short-term investments. Short-term investments. Investments. There is an option of investments, cash and cash equivalents, cash equivalents. They have taken cash equivalents. That cash equivalents are short-term investments, basically short-term. No, short-term borrowings we don't need, right? Do we need short-term borrowings as well? It is already been the part of debt. So we don't need cash short-term borrowings. Generally, cash equivalents capture the short-term investment. Short-term investments are liquid investments that can easily be converted into cash. So this would be the sufficient data, I suppose. But let me check whether cash is included in cash equivalents or not. Cash 546.94. Cash rupees. Cash equivalents and cash is same. Okay. Okay. So we will be removing one of these. It's cash equivalents. Investments, we will see if they have bifurcated into short-term and long-term. Book value of unquoted investment, market value of quoted investments. Investments will also include property, plant, and equipment. Let's ignore investment for now. EBIT. Earning before interest taxes. We directly have EBITDA, but we need EBIT as well. So EBIT and depreciation and amortization. Depreciation. Let's see. Amortization. Amortization is, I guess, included in depreciation only. So we don't have a separate line for depreciation and amortization. We have our depreciation with us. Anything else did we miss? Please let me know if we missed anything. Sustainable growth rate, very important. Sustainable growth rate. We directly have the growth rate available with us. Sales growth, profit growth. No, no, no. Actually, we can take profit growth, but we will ideally calculate sustainable growth rate if it is not available. Return on equity into retention ratio. Retention ratio is not available with us, so we will have to take dividend payout ratio. Dividend payout ratio. Next, and finally, the dividend. Thank you, guys. Thanks a lot, dividend last year. Save columns. Now there could be, okay, sector, industry. Now sector is a broad theme. In a given sector, we have different industries. So they have classified it under personal care. There are 11 other companies in personal care. Let's see if there are more companies in FMCG. So yeah, now also one thing that you need to realize, guys, that these companies are not profit making ones. And Dabur is one of the leading company. So you cannot really compare apples with oranges. Although Godrej Consumer is not making profits, but still it is one of the leading companies. It is serving the consumer to be one of the leading companies. So Yash Optics, JSS 7, these are this cannot be compared with Dabur in a broad manner. So you need to go to FMCG. Let me check. I've never tried this, although I copy the data directly from here. But let me check if this export function, how does it actually works? Okay. They are asking us to get the premium support. Okay. We don't need that. We don't need that. What is they are offering us? For 49999. Okay. No, we will keep it as it is. We will select first 15 companies. First 15 companies. Control C, select the whole range, Control C. Open Excel. Make a sheet name, data sheet, Alt WVG, Control V, Alt HOI, and Control Z, Control Z, Alt S. We just need text. Okay, done. Excel screen is not visible. Just give me a second. Okay. So what we have done, selected first 15 companies. Oh, I'm sorry. Selected first 15 companies. Copy this. Copy this. Come over here. Now is Excel screen visible? Guys, is Excel screen visible to you? Please reply fast. Perfect. Alt ES and T for text. Alt ES and T for text. Alt ES, T for text, enter. Alt HOI. Alt HOI. We don't need this twice, so I'm deleting one of these. Fair enough. Let's decorate this a bit. Home, Since Dabur follows the green theme, I'm going with the theme. Now, these few things, guys, you will have to work out yourself that if the company works on which theme, similar theme, you should follow for your model as well. You can make. So I'm not going to judge you on or give you guidance on color combinations now. That is something that you are mature enough to figure out on yourself as well. Probably better than me. Because to be very honest, I'm not good with colors. And I don't think boys are good with colors. Fair enough. Now, Dabur India is my company. I will keep Dabur India on the first place. I will keep Dabur India on the first place. Let me delete this serial number. Control X, select Hindustan Unilever plus Dabur India came on first place. Now I will add the serial number. Control D. This is the set of serial numbers. Now home, central alignment, yes. Now Alt WVG. I am going to make a relative valuation report. Serial number, and the next thing is company name. Alt HOI. We will add details of which company it is, what is the research report about. We will add all those headings over here. Alt HMC, Alt H. Let's try to put on some color to it. Alt H H. Is equals to sorry is equals to bracket open data. Okay, okay. Is equals to Dabur India and relative valuation model. Now it might be making sense why I have kept Dabur India on the first place. Also, I will be starting my model with Dabur India only. HFS. Once you have logged into Excel, you can throw away your mouse as well. Everything in Excel is possible, apart from few things. But most of try to switch to Excel. When you are using Excel, try to switch to keyboard only. That will help you in the long run. Alt H, FC, white color, Alt H1 for bold. I covered this while the initial class of the financial modeling, that how can you make your own shortcuts, how you don't need to remember any shortcuts. So many of you get confused for page up, page down. So control page up and page down is used. To go page down, we use control page down, and to go page up, we use control page up. Now this will be the data. Control C, Alt SL, Alt H. I am interested to give it a center alignment to serial number and right alignment, sorry, left alignment to the company name. Now, one by one, tell me what are the ratios, what are the set of ratios that we want to calculate. Price, price, first one was price to earnings, right? Now, when you will be adding divide sign over here, sometimes what would happen? Okay, this is working for divide. For addition and subtraction, it usually don't work. So if you might be showing some error, make sure you put a colon to it and start with adding the word. If you are starting with parenthesis, any operator, plus, minus, divide, or multiply, make an habit of starting it within parenthesis. First one is price to earnings. Next one, guys, please help me out with the next one. Price to revenue. Fair enough. Next, price to book value. Thank you. Alt HOI. Next, are we done with? Let's segregate all the price ratio once and then we will discuss the EV part. Price to earnings, price to revenue, price to book value. Is there any other price ratio? Guys, please help me out. Price earnings to growth, that is to be discussed at last. EV to EBITDA. We are done with all the price ratios. Enter price value to EBITDA. Fair enough. Next, EV to EBIT. Next, EV to revenue. EV to revenue. Next, one, two, three, four, five, six. Price earnings to growth. P to growth. And finally, dividend yield. That is nothing but dividend divided by market cap. It would hardly take us 5 more minutes. Shall we just end this by putting the numbers on the data table at least? Shall we get done with this? We don't have to put it for each and every table. We will be just putting it for Dabur India, and rest every numbers will be plotted on their own. So for price to earnings, current market price divided by, okay, for price to earnings, we will first need the market cap. So current market price multiplied by number of equity shares divided by net income, all values in crores. Net income, net income, net income. PAT is my net income. This is price to earnings. Alt H0, sorry, Alt H1, Alt H. I want to reduce the decimals. 9, Alt H9, Alt H9, Alt H9. Fair enough. Price to revenue. Now, since I am using market cap again and again, it would make sense for me. Okay, market cap is already mentioned over here. It would make sense for me to calculate the market cap is equals to current market price, although I feel the number would be same still. Yeah, so what I can do over here is, rather than adding market cap separately, don't worry guys, I won't take much of your time. Market cap divided by net income. Yes, next we again have market cap divided by revenue, sales. Sales is revenue. Yes, sure, I'll share the sheet. Alt H9. Okay. Price to book value is equals to price divided by book value. Control C, Alt ST. Next, EV to EBITDA. Do I have my EV with me? No, I will calculate EV over here. Enterprise value, Alt HOI, Alt HOI. Enterprise value is market value of equity plus debt minus cash. Okay, so I have my enterprise value. Do I have my EBITDA with me, or shall I have to calculate that as well? I will have to calculate it. EBITDA. EBIT plus depreciation and amortization will give me my EBITDA is equals to EV by EBITDA. So finally, EV by EBIT we divide by EBIT, EV by revenue, EV divided by revenue, price earnings to growth, price earnings divided by growth, growth we don't have. So we will be calculating growth. Guys, do you want me to stop or shall we just complete? See, two more rows are remaining. Tell me, please. If you guys are interested, we can stop this. If you guys are interested, we can complete it. Okay, fair enough. I have received two responses. PPMY is saying, ask me to complete. Apurva is saying me to stop this. Okay, GA is saying me to continue. Majority of you are asking me to continue. Okay, just give me a second. Apurva will be done in next 2 minutes. I won't take more than 2 minutes of yours. We need growth rate. We need growth rate. That is sustainable growth rate. Alt HOI is equals to ROE. ROE is in percentage terms. Make sure that we change this into percentage terms. Now, when you will face challenge like this, you want to convert all these into percentage terms, but when you convert this, one solution is 100. Keep it like this. Okay, you want to divide this by 100, so you will keep it 100. Control C, Alt ES. For divide, we will be using I. Okay, Alt H P. Yes, it has been converted into division format. Growth rate, ROE into retention ratio into retention ratio is 1 minus dividend payout ratio. Now this is also in percentage terms. So add this Alt HP. Fair enough. We have price earnings divided by growth rate 664. Oh my God. Okay, huh. We need to again change it to multiply it by 100 and change it to absolute terms because price earnings to growth rate are is an absolute measure. So this time we will be doing 100. Control C, select the whole range, Alt S, multiply, enter, and next thing that we can do is use the decimals. Touch 9, Alt touch 9, Alt touch 9, touch 9. Okay, fair enough. So this is price earnings to growth rate. And finally, I'm really sorry, Apurv, we are done in next 2 minutes. Dividend yield, dividend divided by market cap. Dividend divided by market cap. At least we are done with the overall sector itself does not give any dividend, does not give much dividend. So dividend yield is very less. Yes, I'm sharing the model. Relative valuation model. Do check this and please let me know if I would have made this mistake in any hurry. I'm open to feedback, guys. I would be very much happy to learn from you as much as you are happy to learn from me. It will be also uploaded on LMS, don't worry. So with this, we are done with the relative valuation. We are not done with the relative valuation model. We are just done with putting the data for the relative valuation model. We have just sourced the data yet. We are yet to calculate the intrinsic value of the company. I hope you enjoyed the session for the day. We will see each other next week. And I am pretty much sure you are going to enjoy the session next week as well. So thank you guys. It was really great interacting with all of you. Thank you for being here till now, till this time. Please tell how to access JP Morgan program on IB. For that, there is a different team, PJ. Prajwal, you will have to raise a ticket and team will get in touch with you and they will give you a hands-on experience and how you can get access to it. Yeah, for timing change, I will request that to the management and probably will get that done. So thank you guys. Thanks a lot. It was really wonderful interacting with you. I also get to learn to lot. I also get to learn a lot of things. I also get to learn a lot of things from your end. So I'm really grateful for that as well. It is really wonderful experience interacting with you all. Early morning won't be possible, AV, to be very honest. The earliest we can do is 4 to 6 p.m. And that is something that I'm going to request to the management. So thank you guys. Thanks a lot. Bye-bye. Have fun. What portion of topics is left for 0224? Probably you will be done in next 2 to 3 weeks. Happy Friendship Day, guys. Thanks. Thank you. Thanks a lot. Bye-bye. Have fun. Have a great week ahead. Bye-bye. Thank you. Sorry for extending the session a bit. Thank you. Bye-bye.